So you want to start buying stocks, huh? Don't know where to start? Don't know what to do? Well, I'll help you start off, alright? Here's what you need to do. You need to find a dealer broker. What is a dealer broker? A dealer broker is a person who has an inventory of stock who also can sell it to people. So, how do you find one? Well, you're going to buy it online, obviously, because if you find one in real life, in meat space instead of cyberspace, you're going to be dealing with someone who is actually more of a financial investor, and you're going to be paying a lot more money because they're going to give you advice on what stocks to buy as well. But because you're a informed individual and you have a myriad of tools available to you online to research stock, well, you're fine with these online stockbrokers. Stockbroker is a broker dealer. So an online stockbroker is any company that allows you to purchase stocks by putting in information, which we're going to do in a minute. I remember I saw a nice list of a comparison of stockbrokers. Let me see, comparison of online stockbrokers. It was in Wikipedia. I'm going to refer you to that link. Here we are. If you want to check out a comparison, here they all are. I'm going to show you how to do it in E-Trade. One important thing to know before you choose your online brokerage is that it's really hard to get out of an online brokerage once you're in. Because if you're trading more than one stock, or if you have options contracts, which you might want to do later, over here is the option commission, you are going to find it hard to close all of your positions. In other words, to sell all of your stock and sell all of your options at the same time so you can move your money over to another provider. So you are either going to be stuck with one provider, or you're going to have to be putting money into a new provider and then have similar accounts with different stockbrokers. So please do the research before you get in on one. I like E-Trade because they have good customer services. Their prices are not the best, but it's easy to get into the options section, which you might want to do after you start buying stocks. So quickly look here to determine which online stockbroker you want. The most important thing is the commissions. You want lower commissions, but the lower commissions on this chart are attached to stockbrokers that require higher amounts of initial funding. And you also probably want to make sure you go with a stockbroker that also offers options contracts, because as you'll know later, not from this video, but from other videos and from my guides and courses, trading options is a lot more profitable than trading stock. An ETF, by the way, is you could say it's a surrogate for buying commodities. So if you're interested in investing in gold, you would buy a stock, but it's not really a stock, it's called an ETF that tracks gold. So as gold price goes up, your ETF goes up, and then you can sell off your shares in that ETF to make money. So instead of actually buying gold, you're buying something that's pretty much the same as gold, and you can actually gain leverage and make more money if gold goes up than a person investing in gold itself. Okay, so please refer to this chart to figure out which stockbroker you want. The stockbroker is simply going to buy and sell securities on your behalf. So when you get into one, you're going to have a menu up at the top, something like this in E-Trade. Trade gives you a bunch of options to select. You just want to go to stocks. Once you go to stocks, immediately this will show up. You can also trade mutual funds and stuff like that. If you want to do ETNs, like I just showed you, the ETN over here, ETF and ETN, they're two different things, but they're essentially the same. You can actually put in the symbol for that ETN or ETF right in there and it'll show up. Today, I'm just going to show you the basic method of trading stocks. So after you've opened an account with E-Trade, just go to etrade.com and try to open an account. They'll open an account for you. You'll get in. You will make a bank transfer so that you have money in the account, and then you go to trade, click on stocks. Now, I assume you know the stock you want to trade. I'm going to go with CTCM. I'm going to go with a penny stock because I'm actually going to go ahead and go through with this trade. I'm going to go with a shitty penny stock that I don't care if falls. CTCM is some Russian media news company or something like that. In Soviet Russia, this stock buys you, but because we are in the US and because this stock is listed on the US exchange, we are going to buy the stock. Now, it's a penny stock because technically any stock under $5 is a penny stock. We are going to choose an order type. What are we going to do? Obviously, we're going to buy, and then when you want to sell the stock later, you go back and select sell, right? So we're going to buy the stock, and I'm just going to buy, I don't know, I'll buy 30 shares. Okay? I'm a very uninformed investor for this trade. It's just a simple little experimental trade here. Now, the important thing is the price type. You're going to see a lot of selections. I'm not going to go through each and every one. I'm just going to go ahead and straight tell you that there is one good one and one bad one. The good one is called a limit, and I'm going to show you that in a second. The bad one is called a market. You never want to make a market price type trade. If you buy a market price type trade, I will personally go find you and I will spank you so hard that you're going to need to bring a pillow to your workplace. Okay? A market price type just says, all right, let's go back 1 second, okay? Let's look at what happened when I put in CTCM. Over here, it shows the stock price currently. It also shows the improvement or the rate of falling that happened within the last day of trading. So this went up 0.03%. This went up 3 pennies, which equates to almost 1% in an increase from the beginning of the day to the end of the day. So that's what we're seeing here. Now the important parts are actually down here. The bid side, the bid price and the ask price. And volume is kind of important too. If you're trading a stock with a low volume is probably anything in the, oh my god. Okay, I'm going to shut off Skype right here. If you are buying a stock with a low volume, which is usually something like 5 digits, this is 6 digits, so it's okay. You're going to find that the size of the volume is actually directly proportional to the range of the bid and ask spread. This is called the spread right here. The higher the volume, the tighter the spread is. You want generally a tight spread because it's going to be easier to make a profit. Now what's happening here is people are asking to buy the stock at this price, and people who have the stock want to sell it at this price. Now, who's on the other side? Well, technically someone else has the stock and is going to sell it to you, but what you're really dealing with is something called a market maker. And the market maker is the person who holds the stock and acts as the middleman. So you're actually buying the stock from the market maker, and the market maker is selling the stock back to other people at this price. Now, how do you know what you're going to get? If you put in market, you're going to get the worst price possible. You're going to get whatever the ask size is. So if you buy this and you select market, you're going to be paying more than the actual price of the stock for the stock. Crazy, right? So don't ever do that. Don't let the market maker fuck you over because of this spread. What you're going to do is you're going to pull out your trusty little calculator here, and you're going to calculate the midpoint of this buy-ask spread. 3.52 plus 3.98. Then we divide by 2. We're taking the mean. 3.75. That's the reasonable market price for the stock. So we're going to do a limit. You always want to choose a limit. That's the maximum price you're willing to pay for the stock, and we're going to go with the midpoint. Limit, when you select limit, this website is going to make a limit price entry box appear. So you put in your price, make sure it's correct. Lots of people make mistakes at the beginning and they end up putting in the wrong number, or they do a market trade and they pay way more than they should have for a stock. Now, at the bottom, you're going to see a term selection. Good for the day, good for 60 days, immediate, cancel, fill, blah, blah, blah. I recommend you always select good for the day, because if the next day the price jumps and you have maybe a limit and you wanted to buy it, you're not going to be able to buy it because your limit price is too low. Alternatively, If it jumps down and the limit price is higher than it should be, you're going to pay more than you should. So just keep it good for the day. And if you see something strange happen during the day, you can go back and cancel the order. So we're going to preview the order. You know, I'm probably not going to go through with this trade. I'm going to cancel it later. So we preview the order here. Okay. So it's going to cost me 122 bucks, and my commission's going to be 10 bucks. That's standard commission for most stock and options trades. Then I'm going to click place order to actually place the order. It's placed. Now what you can do is you can go back into, or is it? Orders, okay? And if you're in E-Trade, you go to accounts, go down to orders, select orders. It's going to tell you right here what your order is. You can change it, you can cancel it. I'm going to go ahead and cancel it because I don't like Russian media companies. So I'm going to cancel this order in a second, but that's how you do it. If you have any questions, please leave them below in the comments section, and visit my website for more info. Talk to you later.